Yeah,
Yeah.
it's streaming. Perfect. Okay, I'm admitting everybody now. Good luck, guys.
Jai Jinendra, Namaste, good morning, everyone. On behalf of JITO UK, I, Shubham Jain, would like to invite you all to the Sunday special event of JITO, Buy to Let Part 2, with our special speakers today. I hope all of you would have as good a time as we are anticipating it would be, and we are sure we will only cross those expectations. So, with that, without further ado, I would like to first of all I'd like to invite our fellow board member Rajesh Bhai for the welcome speech. Rajesh Bhai, over to you.
Jai Jinendra, everybody. We start with Naukar Mantra. Namo Yantaran, Namo Shridharan, Namo Ayurharan, Namo Vajayaran, Namo Loe Sapyasaran, Eso Panchanamokaro, Sabve Pao Prasanam, Mangalaran Chicha Sabve Singh, Padman Harai, Mangalam. My name is Rajesh Sethia. I'm one of the board members of JITO UK. I'm honored and privileged to welcome you all here today. JITO stands for Jain International Trade Organization, a global organization set to achieve socio-economic empowerment, value-based education, community welfare, practice of compassion, spread of global friendship, and spiritual upliftment of fellow beings. Globally, it has more than 12 chapters, and most recently, we had Belgium chapters as a new addition. And we are adding new chapters on a very regular basis. JITO UK was established in 2016, and soon we will be completing 5 years of this journey. A journey that has been exciting, nothing short of all the thrills and hard work that is involved in running any startup. Without naming anybody, I want to take this opportunity to thank all of those involved so far, be it the trustees, board members, patrons, most importantly, the volunteers and the audience. UK is blessed with many Jain religious organizations, but JITO UK has managed to work with and garner support from all these organizations to provide a single front when it comes to the economic betterment or rather economic empowerment of our community. It provides a platform for employees, employers, professionals from all fields of network, educate and encourage Jain to Jain trade. Our current board, which was formed a few months ago under the leadership of Nimish Bhai Mehtaji as the chair, is determined and highly motivated to work towards the vision and fulfilling the objectives of JITO UK. As our chairman has pointed out in our first session of the year, that is 2021, look very busy with lots of events planned in coming months. I hope we will continue to have your support just the way it has been so far. Today, we start with second session of Buy to Let. I would hand over this platform back to the secretary and convener of this event. Subham, over to you.
Thank you, Rajesh Bhai. Um, Before we move ahead, we'd like to make a disclaimer that this session is being recorded for the benefit of all participants. If you have any objection to that, would request to switch off your cameras and your mics likewise, because all those contents may get recorded on YouTube. Moving on to another disclaimer, that this is a financial related event, and the information provided on this program is general guidance and drawn from presenters' personal experience and not intended as specific financial advice. So please take necessary precautions. Do not the 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 opinion which is presented is not necessarily representing the views of JITO UK, organizers, sponsors, or any participating entity. And hence, individuals are recommended to seek professional advice as appropriate before making any financial decision. With this, we'd like to move ahead with introducing our amazing speaker for the day. We have got a power-packed group of speakers here, Amol and Brahma. They are both founders of an amazing company, Mortgage Kart. And before founding this company, both of them have got a very relevant and amazing experience of working with HSBC and a very compelling academic background of CA and IMs, as you can see on your screen itself. So we have got indeed a power-packed panel today for you today, and looking forward to hearing from you. When I was actually learning about the speakers, I was so impressed that I actually felt like that Amol sir and Brahma sir, even I'm IIT Delhi, 14 years, kuch mortgage cart mein ho to dekh lena. But yeah, over to you, sir, without any further ado. Let's hear it from you.
Thank you, Shubham, for that very kind introduction, and good morning, everybody. Thank you for sparing your time on Sunday to come and listen and participate in this session. We hope to make it worthwhile by focusing on topics that we think are very relevant for most of us, first generation immigrants for the large part, but also people who are keen to invest or continue their journey as buy-to-let investors. A little bit about Mortgage Kart, if I may, if I can just share my screen. So Mortgage Kart is a mortgage advice firm. We are a fully authorized, regulated FCA entity, which was set up by Brahma and I 3 years ago to help individuals as well as limited companies in the UK with all their residential and buy-to-let mortgage as well as insurance needs. So when Brahma and I were working at HSBC for many years, we felt that mortgages in the UK needed a lot more changes in the way they were sold. We wanted to take the whole process digital, and to that extent, we came up with a hybrid model of actually having a lot of the process taken digitally, yet continuing to lend our expertise through personal interaction with customers. So feel free to reach out to us at any point in time, now or later, for your mortgage needs. As I said, we're fully authorized, and for JITO members, we are happy to provide you our advice entirely free of cost. So it won't cost you a penny, and there is no obligation to use our services. So feel free to call upon us. You can save our numbers or look up our website mortgagecard.com and approach us that way as well. So let me begin our session now. So let's do a recap. We had a session 2 weeks ago where we discussed a lot about the introductory elements of a buy-to-let. We'll go through that recap first. We'll then talk about let-to-buy mortgages, about converting your current residence into a buy-to-let and moving homes and buying a new residence. What are the differences between a consent-to-let and a buy-to-let, and how you can exercise certain strategies to optimize your finances around doing a let-to-buy. Post that, Brahma will cover limited company buy-to-lets and also cover portfolio landlords and some strategies on how we can go about building a limited company buy-to-let portfolio, as well as what are the things that portfolio landlords should watch out for. Feel free to ask us any questions along the way that you want through the chat that you have displayed. and the conveners and the organizers will then take up all the questions towards the end as a Q&A, and we can address whatever doubts you have. So let's begin with any further ado. Let's quickly recap from last time. We said that buy-to-let income, buy-to-let investing creates a passive income. That was the first takeaway that we had. We said that one of the main reasons that people invest in buy-to-lets is so that it creates a passive income as we go further in our lives and we want our active income to be replaced. This is a good way to create passive income. The second thing that we said, that investing in a buy-to-let means you have to think about property. You have to think about how you will hold that property, whether you will hold it in your individual name or whether you will hold it through a limited company. You have to think about what kind of mortgages will you take and why will you take one level of mortgage versus another level of mortgage, or one kind of mortgage versus another kind of mortgage. And then you have to think about the tax implications. We then made the assertion that investing in buy-to-let should ordinarily happen with mortgages because it actually allows leverage. And we showed the mathematics of leverage, how leverage actually increases returns when used in the right way. We then talked about what are the different types of buy-to-let properties. And in the most part, we divided them into two parts: rent yielding properties, which will not offer you as much capital appreciation, but which will give you good rental yields, or lower yielding, but properties that have got a much higher scope for capital appreciation. And we likened it to investing it in income-based mutual funds versus growth-based mutual funds. And then finally, we talked about how your buy-to-let strategy needs to be tailored after you have set goals. So you have to set goals about what you want to achieve with your buy-to-let objectives, and then the strategy needs to be tailored accordingly. We talked about people who have small versus big portfolios, people who go down the personal buy-to-let versus a limited company buy-to-let route, near-term versus long-term objectives, and so on and so forth. Today, we're going to touch upon three main parts in a bit more detail. We're going to talk about let to buy first, and then we'll talk about limited company and portfolio. So let me take you to let to buy. So what is let to buy? Let to buy very simply is a scenario where you rent out the property that you're currently living in and you purchase a new residential property. This is something that is done fairly commonly in the UK, not only by people who are very well heeled, but people who actually go through life, and as they evolve from going through a first property to a second property, as they have families, as their children grow up, for a variety of reasons, this happens over a natural course of time. We all know that in the UK, people really love their buy-to-let investing, and it is often thought of as the best way to invest for your retirement, for your pensions, for your future. So let to buy investing happens in a natural course of events in your life. However, it is slightly different from actually investing in a buy-to-let mortgage, which is done ab initio, at the very outset, with investment as the main goal. Let to buy happens typically by accident. You have a property, you decide that you've got enough cash to buy your next property without having to sell the first one, so you decide to just rent it out. So you're becoming, in some ways, an accidental landlord. That is how most let to buy transactions actually happen or manifest. Now, let to buy is different from a buy to let also because the way let to buy is seen by the regulators, by lenders, is different, and we can touch upon some of those points a little bit later. When you think about let to buy, there are a number of considerations that you must think about. Firstly, many people, as I mentioned, end up holding on to their current homes, not just for financial reasons, but also for emotional reasons. People want to, keep the home in which they have made lots of good memories, in which, for example, their children were born, in which their career started actually flourishing. So a variety of reasons that people have to hold on to property, and that may be, a reason that you have. Or alternatively, you may have the reason that purely that's a great financial decision. I don't need to sell. I'm just going to hold on to it. That's okay too. People can own their properties either in personal names, or sometimes we'll see when it is relevant, they can transfer their property into their own limited company and continue holding it through a limited company structure. There are tax implications to think of. So when you start earning rent, there is added taxes. So you may want to think about transferring a part of ownership to a spouse who may not be working or who may be on a lower tax rate, and therefore it may be beneficial overall as a family to benefit from lower taxes if most of the property is held by a lower earning spouse. Or you may decide that because a let to buy attracts a stamp duty on the new home, you might decide to sell it to your own limited company so that it's more cost effective because you have to pay less stamp duty on the new home that you're buying. And this is especially true for where you're selling a lower priced current house, and moving to a much higher priced, new house. That's where this strategy can come into effect. Or you can have an equity release situation where you don't have a lot of liquid cash available to invest in your new property, but you've already aggressively paid down your old property, and there's lots of equity that you own in your current property which can be released somewhat to then go and put down a deposit on the new property. Some people also do it to actually optimize the total cost across the transactions. The amount of equity that they release is done keeping in mind the overall cost across both buy to let, both the current let to buy as well as the new residential property. And then the final point to keep in mind is that one needs to synchronize the timing on when you buy the new home and you let out the current residence. So there needs to be a deliberate approach on how you actually execute on some of these transactions. So let's touch upon in greater detail what all of this means as we start unbundling this. Now, firstly, when we think about let to buy, there are a number of considerations that we should have in mind. So what is the purchase price of the new property relative to the existing residence? This is one of the considerations that you should have in mind when you think about how to execute on that let to buy transaction. So as I mentioned, let to buy can be done very simply by converting the current property into a buy to let mortgage and just moving, but that may not be the best financial outcome. So in order to determine what is the best way to structure a let to buy transaction, the first consideration you must have is what is the purchase price of the new property. So if you're moving from a starter home to a much more expensive property, it may be a good idea to consider going through a limited company route. If you're simply moving, as an example, for schools, there's not too much difference in property prices. That may have a different impact in how you do the let to buy transaction. If you're downsizing, your children have already grown up and left home, they've gone off to university or they've started working on their own and live independently to you, that may be a different way to actually structure the let to buy transaction. Similarly, if you need to release equity, whether you need to fund a new transaction, you can think about either releasing equity by doing a buy to let, or you can actually completely sell the first property, in which case then the let to buy doesn't apply at all. If, as an example, you need to release some money in order to reduce the cost of your new mortgage, that may be a different way to approach things than just simply needing deposit in order to make the purchase possible. So dependent upon how much is your need to release equity, again, that strategy will be influenced. Now, the third consideration that you should have is the current mortgage. So where are you in the current mortgage with the current residential property? Are you nearing the end of the initial period? Has the initial period already ended? Or are you locked into a long-term initial deal of which getting out of it would mean costly early repayment charges? Do you have the flexibility to port your mortgage, meaning moving your mortgage from the current home to the new home? So these are some other considerations that you must have when you think about how to execute on a let to buy transaction. Finally, from a tax planning standpoint, is the property held in just your name, or is it held in joint names with a spouse? Is your current or expected tax bracket on the particular property? What is that? Are you in a high tax bracket or are you in a low tax bracket? What about your partner? Is there a potential to save stamp duty on the onward purchase by moving the property into a limited company? Do you have trapped capital into your own limited company? Let's say you're an IT contractor and you've got a lot of money sitting in into your own company, is that something that you want to use? So there are multiple ways in which tax planning needs to be done, and the structure of the lead to buy will be an outcome of some of these different phenomena. Moving on, cash flows are the next set. Do you need to dip into your rental income on an ongoing basis to meet expenses? Do you need the liquidity instantly? So will you go on an interest-only mortgage or a capital repayment mortgage? Can you plow back rental income into a private pension pot? There are these considerations as well that you should have in determining what kind of lead to buy strategy you want to adopt. So as an example, if you need the ongoing income, it might not be a good idea to have the lead to buy into a limited company, because then you'll get taxed twice on your rental income. Whereas if you don't need the rental income immediately, it might be a good idea to put it into a limited company. The other consideration is more a lifestyle consideration. Do you want to be a landlord? Because one buy to let might be an accidental thing, versus you want to grow a portfolio in order to earn passive income, might be a totally different way to think about it. Do you have the desire to take on the responsibility of running a limited company, which we discussed, I think, in some level of detail last time, but that also can influence how you think about a lead to buy transaction. We talked about some of the taxation impact, but there's a long-term element around capital gains tax. So for example, when you sell your current home, if it's completely residential for the whole of the period of holding, you will not attract any capital gains tax according to current tax law. But if you rent the property out for the next 5, 10, 15 years, then part of the capital gain may be subject to capital gains tax. Inheritance tax is another angle which you need to think about when figuring out how to structure your lead to buy transaction. And finally, do you have other background buy to lets? Because those background buy to lets will also influence how much stamp duty you will end up paying on the new home. And therefore, all of these different considerations, going back to the previous slide, so there are 8 different considerations we talked about: the purchase price, the need to release equity, the current mortgage, tax planning, monthly cash flows, your own attitudes or choices or lifestyle, longer term planning, and then background buy to lets. All of these different elements need to be thought through in determining what kind of lead to buy transaction should you structure. So it is not as simple or straightforward a choice. You need to give consideration to all of these different things. And when, for example, when we work with clients, we make sure that we cover all of these different points in the recommendations that we make, and we lay out the reasoning for why those recommendations are being made. Let's take a real life example to bring this to life. This is a reasonably simplistic example, but I think it will illustrate some points. So in this example, there was a married couple, both of whom are IT professionals with incomes of 30,000 and 110,000 pounds. They had a very low loan to value on their current residence, but they did not have as much of liquid savings. They wanted to buy a new house for 500,000 pounds and convert their existing home into a lead to buy mortgage. The initial, so say, hypothesis was, we've got about 75,000 pounds to put down towards deposit. Let's take a 85% loan to value product. So they came to us saying that, could you arrange for us an 85% loan to value product for our new home? And they were saying that they would put 15% through their own savings. They also wanted to convert their current residential mortgage into a buy to let, but they had not anticipated releasing any equity. When we looked through the situation, what we recommended to them was that they actually borrow only 60% on their new property and put down 40% as a deposit. Their question was, how do we put down 40% when we don't have it? We said, take 125,000 pound in equity release from your current mortgage, convert your current mortgage into a buy to let, and put down that 125,000 as an additional deposit over and above your 75,000 savings. Overall, their LTV on the current property remained at 60% or under 60%. The LTV on the new property came down from 85 to 60%. And as a result, the overall compared to their ask, we managed to save them £9,000 after borrowing extra on their let to buy property. So just by thinking through as to how you can wisely use the equity, this is a very simplistic example. There's much more complications that can arise, but that just helps you understand, hopefully, that you need to be a little bit more deliberate about how you approach your let to buy transaction. That's broadly, in a nutshell, how you should think about let to buys. Now, what are the possible outcomes when it comes to a let to buy transaction? Firstly, from an existing mortgage standpoint, you can either port the current mortgage to a new property, which means simply taking the mortgage elsewhere and then reapplying for this current property through a buy-to-let mortgage. A second approach can be that you take a consent to let on your existing mortgage, either with or without equity release, and let this mortgage run until the consent to let or your current period expires. This is particularly true when you are in between your initial period, and to break that mortgage will be particularly expensive in the form of high early repayment charges. A third option may be to simply redeem the current residential mortgage and get a new let to buy or a buy to let mortgage in this example, which is called a consumer buy to let mortgage, and then take a new mortgage on the new property. So that could be, these are some outcomes of the existing mortgage. Now let's look at income. So from an income standpoint, your income will also be influenced by whether you take a interest versus a capital repayment mortgage. I think it's more that the capital repayment mortgage will mean higher liquidity commitment towards that mortgage, which means that the rental income you will not get to use as much readily. And then when you invest through a personal name, or whether when you invest through a limited company or a LLP, that will also influence the amount of income that you get and that you are able to use instantly. Brahma will cover this in the next section, but typically with a limited company, we recommend limited company mortgages where people don't need incomes, the rental incomes instantly, and it's always sheltered in a lower tax rate vehicle. That's the reason that we recommend a limited company structure. With property, you can either, the outcomes are that you can either sell the property to a third party, which is normal sale, there's no let to buy transaction, or you can actually sell it to your own limited company, you continue to own it except through a limited company structure. Or the other is plain simple, you convert it into a rental property, you continue to hold it in your individual names. From a tax planning standpoint, it may lead to you changing the nature of how you hold your property, because most people hold property in joint names, meaning in a married couple, they will hold it 50-50 ratio. Whereas if you use an HMRC Form 17, you can actually change the proportion of holdings that you have. There's a more elaborate process which we can discuss offline, but basically there is a way to change the percentage held by each person in a married couple. So as an example, I could, if I'm a low rate taxpayer and my wife is a high rate taxpayer, I could own 10% and pass on 90% of the property. Sorry, the other way, I could own 90% and pass on 10% of the property to my wife, so that from a tax perspective we have optimized this. We could even put the rental income that we earn into a private pension pot, and that's another way of actually reducing the tax liability. Or a third way is to reduce tax liability, to sell to the own limited company or place it in an LLP structure. So there are multiple outcomes from each of the existing mortgage, property, income and tax planning perspective that can be reached because of how you structure your let to buy transaction. That's, I guess, covering let to buy in hopefully in all the detail. Let me pass it on to Brahma now, who will take us through limited company buy-to-lets.
Okay, wonderful. Thank you, Amol. So we've been, briefly talking about limited company buy-to-lets, as Amol had mentioned on his slides. So these limited company buy-to-lets are sometimes also called the SPV, so the special purpose vehicles, and they're called special purpose vehicles because these are basically set up purely for the purposes of buying property, for renting property, and they have no other business except this very purpose. And typically lenders like companies to be set up in this way, so that from a liability perspective, they know that there are no other activities outside of buying, renting, and selling which could impact the fortunes of this particular company. So when we refer to something as an SPV, just take that as a proxy for buy-to-let in this particular presentation. So a buy-to-let, or an SPV here is a company that has been incorporated for the sole purpose of buying and holding residential buy-to-let. And again, please keep in mind that we harp on the word residential. We cannot have the company hold a mix of residential and commercial properties. Typically, lenders like for limited company buy-to-lets to be held in a company, and that is purely be kind of a residential property. The property is owned by the SPV. The SPV actually runs the rental business, and you as the director of the company will infuse the funds required for the purchase of the property outside of what we borrow. But the whole activity of running the business and the ownership lies with the SPV, and you in turn own shares for this particular company. And because this is a company, all the operating income is taxed at whatever the prevailing corporation tax rate is. And this company should be set up with a specified SIC code standing for Standard Industrial Classification Codes. These basically dictate what business this company will do. And that business broadly will be on the lines of buying property, renting property, selling property. So we need to incorporate the company only with those specific SIC codes that are linked to this. And like we previously mentioned about, most lenders typically want these limited companies to be set up such a way that they are purely for dealing with renting, buying, and selling of real estate property, and they don't like companies to have had historical trading activity. So let's say, for example, you are a contractor who have an existing IT company, but who are not going to use this company go forward and want to use the same company for the SPV. That's usually not what lenders would like. They will want you to set up a new company purely for the purposes of limited company buy-to-lets. Okay. Just can we quickly move on to the next slide, please? Okay, so let's take one real life example here, so that we want this to come to life to you as to why, where, how limited company buy-to-lets make a lot of sense. So this is one of our clients where both Mr. and Mrs. are contractors. They were IT contractors, and they were working outside IR 35. And they had a day rate of £500 and £400 respectively. So these guys had substantially good cash flow coming in. And because they were operating through their own IT company, they could manage their salary and dividends. And they remained on the lower end of the tax spectrum. And both of them were paying a 20% tax rate, while most of the funds that they earned stayed back as net profit within the company. So over the years, these guys had accumulated about 150,000 sitting in their IT company, which is basically their own money lying in the company, which they have not withdrawn as dividends, because if they withdrew them as dividends, they would have to pay dividend tax on this amount. And what they want to do now is they wanted to invest in a buy-to-let property, and they wanted to make use of the 150K that is sitting in their limited company, which is their IT company. And they came to us with a solution for this unique situation that they're in. And what they've also told us is that they are just not thinking of buying one or two properties, but in the grand scheme of things and in the fullness of time, they wanted to build a larger property portfolio over a period of time, right? So here we had two options. We could have said, go down the personal buy-to-let option, where you hold the buy-to-let in the personal name. And when we looked at this option for them, one good advantage was that both of them were low-rate taxpayers. So even after sharing the rental income between both of them, on the rental income, they would still end up paying a 20% tax rate. And then, as you all know, the average interest rates on personal buy-to-let products are substantially cheaper than the, a limited company buy-to-let option. So that was something that was working out in the favor of this go personal option. And then since these guys had a high rate of income coming in, we could also use what is called top slicing. And I think we briefly touched upon this when we last met. Top slicing is a scenario where when the rental income alone is not sufficient to support the borrowing, you can use aspects of your surplus personal income. And therefore, this will give you access to more lenders and also more choice, because with top slicing, sometimes you might be able to get a 2-year product, which if this was not an option, you would have been forced to go for a 5-year. So when we looked at all of this, the personal buy-to-let option really sounded great to these guys. But the big kicker in the room was the fact that they had to release this 150,000 from their, IT company. And if we did this using a personal option where they drew it either as, as dividends salary, they would have to incur typically about a 49,000 pound tax bill was what they were going to get stuck with. And what we basically nudged them towards is we actually wanted them to go to a limited company, SPV option. And in this particular case, given the fact that the clients are already low rate taxpayers, whether they pay a corporation tax of 19% or a personal tax rate of 20%, from a tax on rental income perspective, a limited company option was pretty much the same as a personal buy-to-let for them. And then also the interest rates on the personal, on the limited company buy-to-let options were substantially higher, and they also had to retain the rental income in the company, because if they draw it again as directors, they would have to pay dividend tax. But even after considering a couple of these cons that I've just outlined, the very fact that they could save 49,000 pounds of dividend tax and be able to use the full 150K towards the purchase of the property, we steered them down the limited company path. And this is particularly kind of important for limited company buy-to-lets, where lenders allow intercompany loans, where you can get a loan from one company and then use it towards purchasing property in another company, where in these situations where clients have IT companies with large money stuck in them are very, very useful. So basically, the point that we're trying to make with this particular example is that from a taxation perspective, from a cost perspective, the personal buy-to-let option made sense. But there's one consideration around how to free up the 150K trapped in the company and effectively use this, made us choose the limited company option. So, definitely limited company, buy-to-let has its place, and every situation should be uniquely looked at to determine if this is particularly suited for your needs versus not. It's just not a blind, let's go in and buy all our properties from tomorrow in a limited company buy-to-let name. Yeah, hope that made sense. Okay, can we quickly go to the next slide, please? Okay, and again, what are all the considerations? We probably touched upon a few of them in this live example that I just walked you through, but let me quickly bring them all onto one picture here, so that you have a broad bird's eye view of all the considerations that you will have to think through when you're looking at limited company buy-to-lets. The first and most important thing is a limited company buy-to-let is by design a business. So therefore, you do not have the protections that the Financial Conduct Authority will give you for your residential homes or for your consumer buy-to-lets, where you become accidental landlords. So these, at the get-go, you should keep in mind, is a business that you're willfully entering, therefore will not have certain protections that come from the FCA. Okay, so the first thing that you need to think through is the entity structure. For a limited company buy-to-let, the shares can be held either by directors, or some lenders even allow holding companies to also hold shares. Typically, a maximum of four directors, and then roughly an 80% of the shares to be held between the different directors is what most companies will need. And most lenders will need the directors to give, will be required to give full personal guarantees. And then also, sometimes there is a floating charge that is also requested, in the sense that the lender will want them to get paid first should a property be sold as you go down the line. So keep in mind that in a limited company buy-to-let structure, you are giving personal guarantees, but keep in mind that your personal income is not coming into play. The property is still being purchased purely on the strength of the rental income in itself. But then, as a director, you are giving personal guarantee that should something go wrong, then you as an individual will also be liable. Will also be liable to the lender. Yeah. Sources of deposit. Again, this is one fantastic area where limited company buy-to-lets, as we've seen in the previous example, become very, very kind of appealing. You can infuse cash in as a director. You can, in fact, infuse this cash in as a director's loan, and then pull the cash back if you want to, as the company start to make profit. Or, as we saw in the previous example, an intercompany loan can also be kind of allowed, and this can be structured in multiple different ways. Happy to support your particular situation here, but the good thing here is that intercompany loans are kind of kind of allowed by some lenders in the space, and this becomes particularly appealing for several clients. And in the limited company structure, you can have a mix of all kinds of residential properties. You can have flats, houses, HMOs, multi-unit blocks, sometimes even part commercial properties. The only thing that you can't have is you can't mix fully commercial property and actually residential property together under the same company. But you could have a mix of different types of residential property under the limited company structure. In terms of affordability, your rental income is the primary source that lenders look at. And since a limited company pays the corporation tax rate, a limited company is treated as if it's a low rate taxpayer. And we touched upon interest cover ratio last time. And for limited company buy-to-lets, you need an interest cover ratio of 125%, meaning what lenders do is that they basically stress the rental income that you get on this particular property, assuming that the interest rates in the market have climbed up all the way to either 5.5% or 4.5%. And even under this scenario, they want your borrowing to be such that you will have more than 25% cover left to service your mortgage. So 125% is typically what buy-to-lets requirements are for low-rate taxpayers. So a limited company is treated as a low-rate taxpayer. Therefore, you can pretty much borrow a bit more than if you're trying to do this on an individual name as a high-rate taxpayer. Okay, and then from an income standpoint.
At this point, Brahmaji, can I request you to speed up? I see a lot of interesting questions coming up for you already.
Okay, sure, absolutely. We can quickly go to the next slides in the jiffy. Yeah. Okay. And from an income perspective, dividend income, you can have retained income that is kept in the business and then return at a later date. And then you also have the latitude of offsetting a lot of professional costs, which you would not be able to do on your personal name. We move to the next slide, please. Okay, and in terms of tax regime, the most important things that you need to keep in mind are the stamp duty. You will have to pay a 3% surcharge, given the fact that this is on a buy-to-let basis. And your income tax, after offsetting all your costs, are subject to whatever the prevailing corporation tax is. And from an interest cost perspective, your full interest expense can be offset because this is a business that you're doing. And in terms of capital gains tax, for limited companies, there is no difference between a corporation tax and a capital gains tax. And this could also actually save quite a chunk based on how long you hold the property and how fast the property appreciates. And obviously you can subtract all the expenses that come with this transaction before you calculate your capital gains tax. And another very kind of interesting angle to consider for limited company buy-to-lets is inheritance tax, where you have the possibility to set the company up with various classes of shares, and then in terms of long-term succession planning, have the ability and the flexibility to transfer shares to your children over over a 5, 10, 20-year time, and then gift them to your children so that ultimately they become owners of the company and all the properties that the company owns. Can you go to the next slide, please? Okay, so those were all the highlights from a limited company buy-to-let perspective. But there could be some situations where clients might want to hold a large number of properties on their individual names, and this is where portfolio landlords come into picture. And to quickly set the stage on who is a portfolio landlord, all applicants who have 4 or more mortgaged buy-to-let properties are called portfolio landlords. This is 4 or more mortgaged buy-to-lets. So if you have a property that is non-mortgaged, that does not get counted towards this count. And quickly going on to the next slide, this is treated as a specialist lending, where lenders are cognizant of the fact that you have a lot of properties that you're holding on your personal name, and some lenders don't operate in the space. Typically, the definition of portfolio landlord is consistent across most of the lenders, while some use second homes towards this count, some use consent to let properties towards this count, while others don't. But here, the key takeaway is that this is specialist lending, and there are reasons why sometimes this might be preferred over a limited company structure. And the key considerations here are the total number of properties that you own, what your loan to value ratio at a portfolio level is, and also what your portfolio cover ratio is when it comes to your rental liability, your rental income versus mortgage liability, and then also lender level exposure caps. Right. We'll probably quickly go through one more slide, and then I will open the floor up for questions and sessions. So, like I said, the key takeaway is this is suitable for those properties where typically the property values are slightly lower. The portfolio LTV is 75% or lower, and then there is plenty of cover from a rental income perspective, and then over the entire portfolio, there is a decent 125 to 145% rental cover, even at a 5.5% stress rate. And the lending criteria is variable across multiple lenders. We've just cut and pasted the Mortgage Works example here, where they distinguish between clients holding 10 properties and higher. But by and large, again, this is a very unique and specialist type of lending where one needs to have a real reason why to go down this path versus go down limited company versus a clean limited company buy-to-let path.
I think the one point additionally to make is that anytime people are portfolio landlords, the most important thing is that every lender will look at your situation across the entire portfolio. So it's not just the property that you're buying or remortgaging that matters. It's also all of the properties that you hold as buy-to-lets that are mortgaged that will matter. I think that's the main takeaway here. So with that we come to an end of our formal slides, but we can certainly take up questions. Again, just leaving our details here on the screen for you guys to make a note of if you would like help either with your residential or buy-to-let mortgage needs, or for that matter with your life insurance needs. Let me turn it back to Shubham to take it forward.
Thanks a lot, Amol and Rama, for that amazing and engaging presentation that you gave. Personally speaking, I was able to connect with that presentation a lot, and especially the practical examples that you covered during that presentation. They were really helpful in bringing it all to life and making it easy and subtle uh, for all the people in the room today to understand this amazingly complex concept, if I may call it that way. Before we move into the questions that all of us are so eager to ask our esteemed panelists today, we'd like to share with you the list of the upcoming events that JITO has organized for all the members. We have got a financial life skills for ladies in Gujarati and English coming up on 2nd May. It talks about day-to-day management and whole life retirement and then widowhood planning. No biases here. Personally, from my experience, I can tell, I mean, my wife is definitely having more degrees than I have and is usually more financially intelligent than me. But definitely, whatever Jito can add, we would definitely like to invite all the female members and as well as other family members to this event. Another one that we have is on 9th May, again a Sunday. It's on India, our favorite topic, isn't it? And is it a sustainable growth engine for the future? So yeah, again, a very interesting topic, I'm sure, and we'll be looking forward to the event. You can register on our events page and get more information about our events on the same. Also, at this point, I'd like to take an opportunity to invite all those members who are not, all those listeners who are not yet JITO members to become one. When you become one, you become a part of not just JITO, but actually JITO's global network of business leaders, traders, entrepreneurs, and professionals. You do get connected with like-minded people locally as well as across the globe, as well as you get connected to some amazing panelists like we have today, isn't it? Apart from that, you get a chance to empower yourself, your business, and to promote it over the entire platform that we have here at JITO. So if you're interested, we would definitely encourage you to visit our website and become a member there, or email us or contact our friend Nitin Jain, who would be able to help you to become a member. So this is the point that a lot of us were waiting to ask our direct questions from our esteemed panelists today. So if I may, sir, we have a long list here. Let's start with the first, and we'll aspire to cover as many of them as possible. The first question that we have is, in buy-to-let, through limited company, can you get a mortgage solely on the basis of the asset you're buying? Or do you need to provide proof of personal income and or personal guarantees?
Okay, so you're, I mean, to quickly answer this question, what you're trying to borrow is purely dependent upon the rental income on the particular property. Only in very exceptional circumstances, maybe one or two lenders would allow you to bring in aspects of your personal income in, but your borrowability or your borrowing is determined purely based on the, on the rental income. Some lenders have qualifying, income criteria that one needs to have. Let's say it's probably something like a minimum of £25,000 or £30,000 of income. But that's purely just a qualifying criteria and doesn't determine how much you can borrow. And then on a limited company buy-to-lets, the directors absolutely have to give personal guarantees that should something happen to the properties and the firm, then they will step in and they will be liable to the lender.
I should also add that the personal guarantees are extremely important, as Brahma mentioned, but that is not the determinant of whether they will lend or not. So it's a necessary but not a sufficient condition, if that makes sense to you. So the test really, as Brahma has already said, is what is the rental income on the property. That is the basis on which the lending will happen. The personal guarantee is a additional requirement that if you don't give a personal guarantee, you will not get the loan. But if you give a personal guarantee, that doesn't mean that the income is not important. The rental income is not important. That's I guess the point.
Okay, understood. Lovely. So moving on to our next question. To buy buy-to-let property on limited SVP company, is it advisable to buy multiple properties in single company or buy single property in one company and open new companies for each purchase?
Yeah, this is a question we are smiling because we've been asked this question, I don't know, dozens of times. So I think there is no one right answer on this. I think part of it depends upon what you're holding, how long you're holding it for. Are you able to do all the admin work around running those companies, filing confirmation statements, filing accounts, tax returns, etc., on your own? Or are you, because accountants will charge you per limited company. I love accountants. I was an accountant before, so can't say no to accountants. But the reality is, if you're holding 10 properties in 10 companies, you're going to be charged 10 times for your accounting services. So you need to just think about what is the right answer from an overall admin overhead cost management standpoint. There are advantages to holding those properties in different companies. Sometimes you can sell the company itself as opposed to selling the property, because when somebody buys a property, they pay stamp duty on the property. When you buy shares in a company, you pay 0.5% of the share value. So actually you do save money in stamp duty. At least the buyer saves money in stamp duty, which can also be commercially lucrative. But this has to become somewhat more mainstream for these concepts to actually become much more I guess acceptable. It's a journey at the moment. What I would say is that if you have got a large portfolio, it sometimes can be useful, and also from an inheritance tax management standpoint, it can be useful to hold multiple properties in multiple companies as opposed to one company. There's no fixed answer. I guess it's all circumstantial. That's the bottom line. Sorry, it might seem as a cop-out, but that is how it is.
Yeah, absolutely. Had it been any easier, I'm sure we would not have been having this session in first place, isn't it?
That's true.
So yeah, moving on to the next question. Can you change the buy to let to let to buy when the properties are in company? And what are the tax implications of doing that?
I'm not sure I understand the question. A buy-to-let property usually doesn't become a let-to-buy. A let-to-buy property can become a buy-to-let, meaning an existing residence can become a buy-to-let. The person who asked this question, do you want to just quickly unmute yourself and clarify, please?
Okay.
While we wait for clarification, can we move on to next question just in interest of time? And I will
Sure.
clarification on that.
Perfect. The next question is around inheritance tax planning perspective. What should be the preferred route? Should it be limited company versus trusts?
So limited company is a preferred route when there are mortgages in play. Typically, when you're borrowing money from lenders don't like trust structures. It makes lenders distinctly uncomfortable because it's very difficult to penetrate the trust structures from in the event of any kind of disputes and so on and so forth. So lenders usually are not very welcoming of trust structures. If you're owning property in an unencumbered manner, meaning you don't have any loans or mortgages on it, fine, do all the trust work that you want to do. You use trusts as much as you want. But until you have mortgages, typically lenders will not like trust structures. So if you're borrowing money to invest in property, typically limited company is the more favored option.
Perfect. Moving on to our next question. Can one's shares in limited company be transferred to any member of the family?
Yes, answer is yes. There are limits on from a inheritance tax clawback perspective on what you can. So typically per person, so let's say it's me and my wife are transferring shares to our children, each of us can transfer £3,000 worth of shares every year, and they are subject to those taper rules that apply in inheritance tax, meaning that if you're transferring shares and you die, whatever you've transferred for the last 7 years will be subject to tapering rule, which I believe was discussed in one of your previous sessions as well. So the tapering rules will apply to that extent, but you can transfer up to £3,000 per person, per transferor, in a tax free manner.
Perfect. Moving on to our next question. Is there any income tax and stamp duty implication when property in personal name is transferred to a limited company?
Yes, there is. Since your limited company is now purchasing the property, we have to pay the basic stamp duty and a 3% surcharge also on top of that. So that would be the stamp duty that is payable by the limited company.
I think there's also tax consideration from a capital gains perspective. So when you transfer the asset into a limited company's hands, in your hands you will have a capital gain which will be subject to primary residence capital gains tax relief. So therefore you'll not end up paying any taxes on it. So for example, I had a property which I bought for 250,000 and sold to my own limited company for 500,000. That 250,000 gain in my hands as an individual is tax free. The limited company's purchase price will be 500. If 10 years later that sells for 700, then the limited company will have to pay corporation tax on £200,000. That's broadly the way it will work.
Okay, lovely. So at this point, I think we've got an explanation of the question that I asked earlier. The question was, I have buy-to-let in limited company. Is it advisable, or to your reaction earlier, is it possible to convert to a lit to buy? Or is the question still?
The way the way I kind of understood the question is, once we convert this into a buy-to-let with a limited company, can we live in the property? The answer to that is absolutely no.
No. So you can't live in a property that your limited company owns. That will not be allowed, at least until there is a mortgage in place. Once the mortgage has been paid off, then you can do whatever you want. But until a mortgage is in place, the lender will not allow you to live in that same property. Can it be converted? It can be converted back into a residential property if, for example, your limited company sells the property to you. Then it can happen, but not whilst it is still under the limited company structure and it is mortgaged.
Okay, thank you. Moving on to the next question. Can you claim the input VAT, the VAT which is paid to the suppliers from HMRC by setting up an SPV?
Yeah, an SPV is a normal, limited company. You can register it for VAT. You can claim any input VAT that you have, so long as you can prove that the purchase was done for business reasons. Obviously, you can't, put all of your Tesco shopping on it and claim VAT back. That won't be allowed. But I think, if you can prove that there is a business link between, what you have paid input VAT for, then yeah, absolutely. And so long as, you are VAT registered and you're paying VAT, absolutely you can keep it for it.
I had a personal related question. So would the stamp duty be covered under these expenses which can be?
Yeah, so in a limited company, when you buy a property through a limited company, even the stamp duty expense that you have incurred can be offset, from your total profits or your total, I guess, capital gain or whatever. So that is a deductible expense. Yes.
Okay, perfect. Moving on to the next question. It is for company buy-to-let. If we draw dividends, then they're also taxed as a part of the personal income. How can we efficiently utilize the company profits in that case?
Yeah, I think that this is one of the challenges with a company buy-to-let. One of the things that is a golden rule is that you have to retain all these profits inside the company and start taking dividends only when you don't have a main source of income. That's when you will actually benefit from it. Otherwise, if you're earning £100,000 plus, whatever you're earning, and you're still taking dividends out, you will be taxed twice. Once in the company, because the company has to pay whatever 19% today tax rate. And then the distribution of profits happens in your own hands, because that dividend is also subject to tax. So always there will be a double whammy that you will incur if you are continuing to pull money out of the company. For us, the right strategy is to actually keep the money in the company and use the accumulated profits to buy more property. That is the right way to use it. If you need that money instantly for your to substitute your income, as an example, to supplement your income, then limited company may not be the best way to go about this.
Okay, perfect. Fine. While I understand most of our JITO listeners as well as members, they are either self-employed or they are, in very good contractual roles. I don't know who has asked this next question. Okay, it's me. So for someone in a full-time salaried and taxed employment, is there any tax benefit in investing through a limited company rather than a personal buy-to-let?
Yeah, so there definitely is a case for employed people who are on higher tax rates to consider limited company for 2 or 3 different reasons. First, if you are a higher rate taxpayer, invariably you're constrained on how much you can borrow, because on personal buy-to-lets you have got higher thresholds. So you basically the stress rates and so on or interest coverage ratios on property are typically higher for individuals than for limited companies. So you can borrow less, you can get less leverage if you're borrowing in a personal capacity than if you're borrowing in limited company. That's the first difference. The second difference is that on all the rent that you earn in your personal name, you'll pay 40% in taxes minus some tax credits that you get on your interest. But if you go through a limited company, that will be taxed at 19% as opposed to 40 or 45%, whatever your marginal tax rate is. So to that extent, you will benefit. However, ultimately, this is a very kind of specific question. I don't think there's a generic answer I can give. It has to depend upon what that particular situation is. So, come to us with your situation and we can tell you whether one way or a different ways is better in your case, rather than, answering it as generically. That makes sense to me.
Perfect. I know we have already run over time, but can I ask a couple of more questions? I see there are a couple of more relevant ones that we have. Would it be fine with you, sir?
Yeah, absolutely.
Okay, perfect. So does portfolio landlord rules apply to limited company too? Example given, if the company has more than 4 buy-to-let properties.
Right. So if once you go down the limited company buy-to-let, the concept of portfolio landlord doesn't apply. You're going down the limited company buy-to-let path, and then the limited company can have as many properties as possible. It is just that if it's in your personal name and you're trying to borrow an additional property in your personal name, is when the portfolio landlord rules apply.
Okay, perfect. The next question would be, what are stamp duty implications when it comes to buying a property which is already held within a limited company?
So how is the transaction being structured here? It's already held in the limited company. And what is happening to the property now? Who's buying it from whom?
From what I gathered, is
stamp duty is a buyer's concept, not a seller's concept. Who owns the property today is not relevant. The question is who will own the property going forward.
Okay.
The buyer has to pay stamp duty, at least as per rules today. Tomorrow, if the chancellor introduces seller stamp duty, then it might be different.
Yeah, you never know what sort of new funny taxes might come in the post-COVID area, isn't it?
But at the moment, I think the buyer matters, not the seller.
Okay. So the next question would be, if someone is a first-time buyer, which option has more advantages? Buying on personal basis or limited company route?
Yeah. So as a first-time buyer also, so if you're saying that if you're a first-time buyer and buying to rent, again, it invariably, will depend upon all of the different things that we talked about, from a tax rate perspective, from a what your current income situation is, what is beneficial, from a longer term perspective, all of those things. So I don't think that there is necessarily a huge distinction to draw. Brahma, you might know better than me on whether first time buyers can get limited company mortgages.
Yeah, well, first time buyers, I think the catch is typically lenders don't like people to get their buy to let without having their own property first, because one of the largest considerations that lenders have is that if they do kind of allow this, one would get a buy to let property on an interest only and start living in it, right? So typically lenders require you to be a previous resident, a previous owner before you get your buy to let. In a personal buy to let, there are some exceptions where lenders will let you get a buy to let as your first property, but not for limited company buy to let. You absolutely have to have owned the property before and be living in it to get a limited company buy to
let. Okay. Fine. The next question would be, what are the benefits of buy to let over upgrade to a higher price property? So is there any real benefit, as all the tax advantages of buy to let may be offset by the capital gains tax on the main property?
I'm not sure I understand the question.
So, from what I gather in this question, it would be that if, say, someone has got two options, either to upgrade to a higher price property or maybe to buy a parallel buy to let property. So which one would be more tax beneficial of the two strategies?
Okay. I think now I understand it. So look, so if you are concerned that by actually getting all the advantages of buy to let, all of that will be diluted because you will not be able to get capital gains benefit on that buy to let anymore, then it might be actually a good idea to sell the property to a limited company and take them the next home. So ultimately, the best way to think about this is, what is the overall stamp duty saving by transferring to a limited company, if at all there is any, and what is the capital gains tax implication, and finally what is the ongoing tax incidence on the rental income. All these three things will need to be thought through before deciding what is the right strategy. Is it to rent on the individual name? Is it to rent through a limited company? Or is it to just sell off the property? And again, individual circumstances will matter. So best thing is to actually look at this specific example, and we can guide what is the right answer.
Okay, perfect. What are the capital gain implications in transferring property to a buy to let company?
You mean a property from a personal name into a limited company?
Yeah.
Right. So, it depends on how long you've held this property as a buy to let. Let's say, for example, Amol spoke about let to buys, right? This is a situation where you're living in a property and you're now converting it into a buy to let. And then if you sell it to your limited company at that point of time, then there's no capital gains tax because you've lived in it. You have lived in this property as your primary residence, and if you just sell it to your limited company, there's no capital gains tax. But let's say, for example, you have lived in the property for 10 years, you have rented it for 2 years, and now if you're selling it, then for the 2 years that you've held the property as a buy to let, you have to pay a proportional capital gains tax for that. For that period of time. Hope that made sense.
Yeah, absolutely. As much as it can. When two complex areas of mortgages and taxation, they come together. So that's where the cocktail of complexity happens. Okay. The next question would be, I have a buy to let, meaning the the asking person, they have a buy-to-let on the personal name, and now if I want to transfer to limited company by 4 family members, what is the best way that it can be done?
So the four. Yes, sorry.
Yeah, so right now it's in personal name, and they want to transfer it to a limited company, which is
held by 4 family members.
Yeah, held by 4 family members.
Right. So you would have to set up, an SPV with the 4 family members as the 4 directors, and then the special purpose vehicle can buy the property from whoever owns it right now.
So sometimes, again, one of the things that can also happen with some lenders is you don't even need to actually, the limited company doesn't even need to put up the cash to actually make this happen. So just the transfer can happen as if equity is being transferred. That also can happen. You don't need to actually pony up the cash to make this happen. That's the other advantage of going through this option.
Okay, lovely. So thanks a lot for your time today in answering so many questions of our lovely listeners today. So at this point, if I may, can I please invite Ms. Bijal with the vote of thanks. Over to you, Bijal. Would you like to unmute yourself?
Yeah, completely forgot about. Thank you, Mortgage Kart, for your comprehensive knowledge and valuable time today. And thank you, JITO UK, for organizing such a wonderful event on the Sunday morning and organizing such a knowledgeable event. And thank you again, our not to forget the long-standing sponsors and Kumline sponsors, and all the audiences and attendees for attending today. I hope you would have gained a lot of knowledge on from the expertise of the Mortgage Card and Mr. Amol and Mr. Brahma, and definitely you'd be getting a lot of queries and inquiries to consult you on your expertise. Thank you very much for your time, everyone.
Yeah, and not to forget Mortgage Card themselves as the sponsor of this event. Thanks a lot, first. Thanks a lot, sir.
Thank you.
And as we noticed in a lot of the questions, there's so much subjectivity that a personal consultation is, I believe, many times the best solution to most of the problems. And hence, Mortgage Card have very kindly agreed to take up consultation for the JITO members. So we would absolutely encourage all the members to avail that facility and benefit and find semblance in the subjectivity of this particular topic. So again, thanks a lot, our sponsors and panelists today, for giving it as a facility to the JITO members. I'm sure I'll definitely be calling you within today itself to speak to you again. So yeah, thanks a lot for getting into the session, and thanks for all the listeners today. We hope you found it useful. If you have any feedback, please feel free to reach out to us, give it to us, email us, phone us, whatever works. And definitely feel free to reach out to our panelists as well if you have any further questions. Thank you. Have a nice day.
Very much.
Have a nice Sunday.
Thanks, everyone.